Welcome back to the deep dive. Our goal here is always pretty straightforward. We take these incredibly dense financial reports, the ones packed with inflation adjustments, endless footnotes, data that sometimes feels designed to confuse, and we try to boil it all down into clear, actionable knowledge just for you, the individual investor.
Mm.
And today, we're doing a really crucial deep dive into Anatolia Biotechnology Ürünleri, or ATBYO, as it's known on the exchange.
That's right. We're looking at their whole financial picture for the 9 months ending September 30th, 2025. And it's really important to say right up front, this whole analysis, everything we discuss, is based on figures adjusted for inflation using the Turkish accounting standard, TMS 29.
Right.
And that adjustment is absolutely critical because, well, it forces us to look past potentially misleading nominal numbers and really dig out the true operational story that's kind of hidden beneath all that accounting noise.
And it really is a fascinating story, isn't it? Almost a paradox, especially for a high-tech company like ATBYO. I mean, on one hand, you see these absolutely stellar underlying gross margins, really validates the quality of their R&D.
Absolutely.
But then you look at the headline figures, and they just scream severe net loss. So our job today really is to try and reconcile those two kind of conflicting realities.
Exactly. What we're really tracking in this report is a company going through a pretty radical financial transition. You can see a significant shift in their liquidity profile. They've historically been very cash rich.
Uh-huh.
And now they're moving towards taking on significant leverage.
Mm-hmm.
And that move, it's driven almost entirely by some really aggressive, strategic, and frankly, massive capital expenditure.
Right.
So we need to understand the sort of risk-reward calculation behind that whole transition.
Okay. And just a quick reminder for you listening, if you value this kind of detailed analysis, the kind that cuts through hundreds of pages of reports and puts the essential knowledge directly into your hands, please do engage with this deep dive. Like it, subscribe, share it. That support really does allow us to keep bringing this level of scrutiny to the market for you. Okay, let's unpack this company first then. Before we really dive into the numbers, we need a clearer picture of who ATBYO actually is and, why they matter in the whole biotech sector.
Right. So Anatolia Biotechnology is a highly specialized company. They're vertically integrated, focusing squarely on molecular biology diagnostics, their core business. It really revolves around intensive R&D, design, and the manufacturing complex diagnostic and research tools.
Okay, so what kind of tools are we talking about?
Well, think cutting-edge stuff. Products using techniques like real-time PCR, sophisticated DNA sequencing systems, advanced DNA isolation kits, and then, of course, all the necessary associated robots, software, and devices that go with them. This isn't your mass-market production line. It's precision, high value, very much intellectual property-driven manufacturing.
And geographically, where are they based? Where does this high-tech operation actually happen?
Their main hub, which includes the company headquarters and their primary R&D center, that's in Sultanbeyli, Istanbul, but they've got a smart setup. They also maintain a separate branch specifically for production activities, and that's within the Tuzla Free Zone, also in Istanbul.
Ah, the free zone. That's often strategic, isn't it?
Absolutely. That free zone operation is really important for them. It facilitates their extensive export activities, often providing, logistical or fiscal benefits that really bolster their international competitiveness.
You mentioned exports. How wide is their reach globally? And maybe more importantly, how do we actually gauge their standing, their technological standing, against the big global players?
Their geographic footprint is genuinely extensive, especially for a Turkish biotech firm. They're currently exporting products to over 50 countries. That spans Europe, Asia, Africa, and the Americas.
50 countries, okay.
But to your point about technological validation, this is probably the single most critical non-financial detail in their entire report. Anatolia is the first and only Turkish manufacturer ever invited by the World Health Organization, the WHO, to collaborate on establishing new global test reference standards, and that's for 4 distinct viruses.
Wow. Okay, hold on. The first and only Turkish company invited by the WHO to help set global reference standards. That's huge. That sounds like a massive piece of validation. It's one thing to say, oh, we sell globally, but being invited by the WHO to actually help define the benchmark, that suggests a level of technological trust and quality control that puts them right up there with the world's elite manufacturers, surely.
It absolutely does. You've hit the nail on the head.
Yeah.
This invitation, it's a massive competitive advantage. It might not show up directly on the income statement, not yet anyway.
Right.
But it establishes a profound competitive moat around them.
Right.
It basically confirms that the rigor of their R&D, The consistency of their manufacturing, the reliability of their kits it all meets, and maybe even helps define the highest international scientific benchmarks. It essentially de-risks their technology in the eyes of regulators and, importantly, large institutional purchasers all over the world.
Okay, that's a really critical piece of context. Let's shift focus a bit now. Look inside the company. Let's talk about ownership, governance. What's the capital structure look like, and who's really steering the ship?
Okay, so the company's paid-in capital right now is 220 million Turkish lira. However, the report flags a pretty significant recent development. They successfully got approval from both the Capital Markets Board, the SPK, and Ministry of Trade to increase their registered capital ceiling, basically the maximum they could issue, to a massive 7.5 billion lira. And that's for the period 2025 to 2029.
7.5 billion. That's a huge jump. What does that signal?
It signals management is definitely preparing for substantial future growth. They're potentially paving the way to use the capital markets, maybe issue more shares down the line to help fund those enormous CapEx ambitions we mentioned earlier.
Got it. And who actually holds the reins? Who has the controlling interest?
The ultimate control lies with the founding partners. You've got Elif Akyüz holding about 20.73% and Alper Akyüz holding the larger share at 42.53%. Now, the public, investors like you, have been able to trade the shares on Borsa Istanbul since 2021. The free float, the shares actually available for trading, was sitting at about 35.43% as of the report date.
Okay, so about a third is publicly traded.
Yes, but, and this is a vital governance detail, there's a dual share structure in place.
Ah, okay. Tell us about that. That's always crucial for minority shareholders to understand.
Definitely. The capital is split into A and B groups. Now, the A group shares, there are 40 million of those, carry significant voting privileges, extra voting power. And all of these A group shares are held solely by the founder, Alper Akyüz.
So even though over a third of the company is publicly traded.
Exactly. The existence of these A group voting shares means that the founding partner retains absolute management and strategic control. It essentially insulates the key executive decisions from the influence of the public float, regardless of that 35% free float number.
That clarity on control is really important for any investor assessing, how much influence they might actually have. Now, shifting to the board of directors itself, something immediately jumps out when you look at the list: the representation of women in leadership roles.
Yes, indeed. And, when we think about corporate governance and the increasing focus on ESG metrics globally, Anatolia actually presents quite a remarkable case study here. The board has 5 members in total, and 4 of them are women.
4 out of 5.
4 out of 5. You have Elif Akyüz, Kumru S. Soran Selçuk, Professor Dr. Işıl Kurnaz, and Professor Dr. Doygun Erol Barkana. That works out to roughly 80% female representation on the actual board of directors.
80%. Wow, that's exceptionally high, isn't it? Especially, I'd imagine, in a high-tech manufacturing sector. It certainly suggests a progressive approach to leadership and diversity. That could be a strong signal for institutional investors who really prioritize corporate governance metrics.
Oh, it's definitely a differentiator. It shows a clear commitment to tapping into a diverse talent pool for that crucial strategic oversight. Now, moving from the board down to the workforce itself, the group maintains a pretty robust team. They had 247 employees as of September 30th, 2025.
Okay. And what about compensation, particularly for the senior leadership? What are we seeing there?
Right. This is where that TMS 29 inflation adjustment really makes things, tricky to interpret at first glance. The report shows the total gross compensation and benefits provided in top management for the 9-month period was 33.3 million lira in 2025. Now compare that to 41.9 million lira in the prior year. But remember, both those figures are adjusted to September 2025 purchasing power.
So wait, that's a drop of about 8.6 million lira in real terms. That sounds substantial. Is management actually taking a real pay cut here, or is this just some kind of artifact where maybe their nominal pay hike didn't quite keep pace with the massive inflation rate used in that restatement calculation?
That's the key question. Since both periods are inflation adjusted back to the same point in time, the decline strongly suggests a real reduction in the purchasing power of the total executive compensation package.
Interesting.
It is interesting, especially in an environment where the company is basically asking the market to tolerate short-term losses because of this long-term CapEx push. Seeing a real decline in executive pay, whether it was intentional cost-cutting or just failing to fully keep pace with inflation, it does offer a subtle signal to investors, doesn't it? About management's current financial alignment, perhaps with the belt tightening needed for this big investment phase. It's definitely an unusual data point in such a high inflation environment.
Yeah, it really is. Okay, let's zoom out again. Look at their international operations. We know they're global players selling in 50 plus countries, but are these overseas subsidiaries the sort of distribution beachheads? Are they currently helping the bottom line, or are they actually acting as a financial drag right now?
The detailed financial notes paint a very, very clear picture here. In the short term, these strategic international ventures are proving to be a significant financial drag. Anatolia has subsidiaries focused on distribution in key markets. There's Alpha IVD in Italy, Euronano in Pakistan, Rheingene Poland, Rheingene Germany.
Okay, so what are the actual results from these ventures? We need some specifics here, especially given how important international sales are supposed to be for their future.
Yeah, the numbers are pretty stark. For this 9-month period we're looking at, Alpha IVD in Italy reported substantial loss of 45.4 million lira. Rheingene Poland was also firmly in the red, reporting a 14.7 million lira loss. Yeah. And other subsidiaries, like Rheingene Germany, posted really minimal revenue, just about 848,000 lira, while still obviously contributing to the overall consolidated loss because they have operating costs.
So hang on. These international distribution arms, the ones set up specifically to leverage the company's valuable R&D output, they're currently acting as major cost centers, and they're actually fueling the group's overall consolidated net loss. I mean, how long can the core Turkish business really subsidize that level of international operating expense?
That really is the multi-million lira question, isn't it? They clearly represent a massive investment upfront in market presence and getting product registration, setting up logistics. Management is obviously prioritizing establishing these permanent localized distribution channels over achieving immediate profitability in those specific regions.
Yeah.
We also see some evidence they're trimming the fat, so to speak. The decision was made back in May 2025 to actually close down the Rheingene Philippines subsidiary. That suggests management is actively reviewing performance and focusing resources where they think they'll get the best long-term return. But as things stand right now, the operating performance of these foreign entities is undeniably a critical downward pressure on the consolidated bottom line.
Okay, we understand the strategic positioning, the governance, the international setup. Now, here's where things get really interesting as we move into the core financial engine itself. Let's take a closer look at profitability and operational performance.
Absolutely. So we start right at the top of the income statement with zero, or sales revenue. Now, when we compare the 9-month period of 2025, that's 509.0 million lira, to the same 9-month period in 2024, 506.2 million lira. And remember, both figures are inflation adjusted. We see the top line's almost perfectly flat, barely moved.
Flat revenue, in real terms. For a technology company that's been selling products for years and is supposedly investing aggressively in R&D, that feels highly unusual. It implies that real sales volume growth, or maybe price increases beyond just matching inflation, were almost non-existent in this period. Why the stagnation? Any clues in the mix?
Yes, the mix is quite revealing, actually. Domestic sales within Turkey, they actually grew slightly. They went from 265.2 million lira up to 284.5 million. So some growth there.
Okay.
But international sales, which, as we said, are crucial for their global ambition, they actually declined from 236.7 million lira down to 224.0 million. So this decline in exports, it could suggest a couple of things. Maybe they're facing really intense competitive pressure in those 50-plus export markets, or perhaps it's a strategic choice by management. Maybe they intentionally prioritized conserving cash and resources for that massive CapEx project rather than pushing for aggressive, maybe margin-diluting international sales drives just in the short term.
Right, maybe pulling back slightly internationally to fund the big build at home. Okay, so if the top line is flat, let's look immediately below that. The Broodcar gross profit line. This is where Anatolia's proprietary tech, that WHO-validated quality, should really shine.
And this is truly the company's financial bulwark, their strong point. Gross profit remained remarkably stable, 334.7 million lira in the first 9 months of 2025, compared to 332.3 million in the same period of 2024.
Very stable.
Very. And the corresponding gross profit margin is exceptionally high and also stable. It's sitting at 65.76% for the current period, almost exactly matching last year's 65.65%.
65, almost 66% gross margin. Wow. I mean, in the global diagnostics industry, margins like that strongly suggest some deep intellectual property protection, right? Proprietary technology that's hard for competitors to replicate, and probably robust pricing power, too. It really seems to confirm that the R&D investment is yielding valuable, high-margin products.
Oh, absolutely. It's the clearest signal you can get of the underlying economic health of their core technology. However, If you dig into the cost of goods sold, the Cochias breakdown, there's an interesting internal shift happening. The cost associated with selling purchased commercial goods stuff they buy and resell that jumps significantly from 52.1 million up to 68.8 million.
Okay.
But the cost of their own manufactured finished goods actually decreased from 117.1 million down to 101.8 million.
Interesting. So maybe their sales mix is pivoting slightly towards distributing other companies' products alongside their own, or perhaps they've achieved some major cost efficiencies in their own core manufacturing process.
Could be a bit of both.
Mm.
But this is where the operational story really starts to derail, isn't it? When we move further down the P&L and look at the ISA's Feliet Karen, the operating profit, precisely. This is the moment where the positive financial narrative kind of collapses. The operating profit, which, remember, represents the core profitability of the actual business before you factor in interest and other non-operational items, it absolutely plummeted. It went from a solid 60.5 million lira in the first 9 months of 2024 down to an extremely vulnerable 8.57 million lira in the same period of 2025.
Wow, 60 million down to just over 8.5 million. That's almost an 86% operational contraction in real inflation-adjusted terms, despite that super stable high gross margin.
That's a dramatic drop.
That is just astonishing. If the gross margin is stable at 65, 66%, then all that pressure must be coming entirely from the operating expenses below the gross profit line. Let's break that down. Where did this massive operational contraction come from?
Okay, we can trace it primarily to three main levers, three main areas. First, the good news. General administrative expenses, G&A, were actually reduced slightly.
Yeah.
So that shows some decent cost management there.
Okay, good start.
However, marketing expenses jumped sharply. They increased from 159.5 million lira up to 180.2 million. So the company's spending substantially more money, 180 million lira, over 9 months essentially, to generate a flat 509 million lira in real revenue. That disconnect immediately hurts the EFK.
Yeah, it sounds like they're running harder just to stay in the same place, revenue-wise. That's often a symptom of either rising competition or maybe just poor marketing return on investment. Okay, what were the other two factors driving down that operating profit?
The second factor is the disappearance of non-core operational income. There's a line item, ISA's Falietlerden, Dizer, Galer, other operating income. That was nearly cut in half. It dropped dramatically from 72.6 million lira in 2024 down to just 36.1 million in 2025.
Big drop.
Huge drop. This suggests they probably had some significant one-time income in the previous year, maybe from things like government grants, perhaps selling off some small assets, or specific contract clauses that paid out income that simply didn't repeat this year.
Right? A one-off boost in 2024 that wasn't there in 2025. And the third lever, that's often where you find unexpected costs lurking.
Exactly. The third is the dramatic increase in ISA's, Filielderden, Dear Gitterler's other operating expenses. This category more than doubled. It soared from 17.6 million lira up to 40.0 million lira.
40 million lira in miscellaneous operating expenses. That's substantial and clearly critical to this collapse in operating profit. And what exactly is hiding inside that bucket? Do the footnotes give any clues? Could it be operational write-offs, maybe legal costs, or perhaps costs linked to shutting down that Philippine subsidiary you mentioned earlier?
The footnotes often provide some clues, but these other expenses accounts can sometimes be a bit of a catch-all. Given the huge strategic shift the company is undergoing, we can probably speculate that 40 million lira increase likely includes things like higher expenses related to the initial phases of that massive investment, maybe site preparation costs, specific consulting fees they had to pay. Could be legal or regulatory costs tied to managing their foreign distribution setup, or even, as you say, one-off write-downs related to perhaps some inventory or non-performing international assets like the costs associated with closing Rhein Philippines. Okay, so you put it all together. Increased marketing spend, halved other income, and doubled other expenses. That combination perfectly explains why that operating profit almost vanished.
We absolutely have to address R&D accounting here as well, because that definitely influences the reported EFK, doesn't it? We know they spend huge amounts on R&D.
They certainly do. And this is a critical point. While the main profit and loss statement shows R&D expense as basically zero in 2025, you have to dig into the footnotes. Footnote 13 and 26 confirm they actually spent a staggering 133.5 million lira on development projects during this 9-month period.
133 million spent, but zero expensed. How does that work?
It points to a critical accounting policy choice they've made. The company is heavily utilizing the option to capitalize its R&D costs. Essentially, they treat these significant development expenses not as an immediate cost hitting the P&L, but as an intangible asset built up on the balance sheet.
Right.
The cost is then only realized gradually over time through amortization charges, rather than being expensed immediately in the period it was spent.
Okay, that's a massive decision from an accounting perspective. If they had chosen to expense that 133.5 million lira R&D spend immediately, well, that already tiny positive 8.57 million lira operational profit would instantly become a massive operational loss of over 120 million lira for the period. So this accounting policy dramatically alters the appearance of short-term profitability.
It absolutely does. It essentially defers the full impact of their R&D spending into the future, aiming to align the cost realization more closely with the future revenue generated by those new products. But investors absolutely must understand that the true cash cost of running that R&D engine is significantly higher than what the reported EFK suggests. And of course, those capitalized assets sitting on the balance sheet will eventually lead to higher amortization expenses hitting the P&L in future years.
Okay, so let's move down to the ultimate bottom line then, net income, and the profound impact of that inflation accounting we keep mentioning. The reported loss is quite alarming.
It is. The period net loss actually deepened further compared to the previous year. It increased from 250.4 million lira in the first 9 months of 2024 to a staggering 294.6 million lira loss in the first 9 months of 2025.
Nearly 300 million lira loss. That headline figure looks disastrous. It suggests the company is just hemorrhaging money. But as we've established, the main culprit here is almost entirely that accounting standard, TMS 29, right?
That's exactly right. Tell us again just how TMS 29 creates this, frankly, misleading picture.
Well, the overwhelming component, the vast majority of that 294.6 million lira net loss, is something called the net monetary position loss. For this period, that figure stands at 265.8 million lira. 266 million just from that.
Yes. And crucially, this is a non-cash theoretical loss. It's the loss that the accounting standard requires the company to report simply because the group held net monetary assets, things like cash itself, or money owed to them by customers' receivables assets whose real purchasing power was eroded by Turkey's very high inflation rate during the period.
Okay, so that highlights the distortion perfectly. Despite the operational contraction we discussed, the core business itself is still marginally profitable. That EFK was positive at 8.57 million lira. But the accounting rules mandate this nearly 300 million lira loss primarily because the lira lost value against the goods and services those assets could buy.
Precisely. The net effect is that the actual profitability generated from selling those high-margin test kits is completely overshadowed, completely masked by the systemic financial drag of simply operating in a high-inflation economy while holding on to net monetary assets. It's really an economic environment issue, not solely an operational failure of the business itself.
Right.
However, we shouldn't ignore the operational weakness entirely. The company's own activity report confirms that operational efficiency is also weaker.
Yep.
It shows the EBITDA margin fell significantly, from 32.07% down to 24.09%. So that confirms that even before you apply the inflation accounting impact, the company is generating less operational profit per unit of revenue than it was before.
Okay, so there's pressure on operations and this huge inflation accounting loss layered on top. Got it. Now, if we think of the balance sheet as sort of the hull integrity of this high-tech vessel, we're seeing some pretty massive structural changes happening in 2025. Let's analyze the financial health, the liquidity position.
Yes, the balance sheet really reveals the sheer speed and commitment behind their strategic investment plan. We absolutely have to start with the liquidity ratios because they've seen a massive, almost you could say, reckless contraction. The current ratio that measures short-term assets against short-term liabilities, it plummeted from an incredibly safe 8.66 at the end of 2024 down to 3.71.
Whoa, wait. From 8.66 down to 3.71. That's a huge drop. But 3.71 is still incredibly strong, isn't it? I mean, it suggests they can still cover their short-term debts nearly 4 times over. So while the velocity of the decline is dramatic, the end result still looks like pretty robust solvency, wouldn't you say?
That's true. Yes, the absolute figure, 3.71, remains healthy, no question. But the cash ratio, which is the most conservative measure, looking only at immediate cash and cash equivalents against those short-term liabilities that plunged even more steeply.
Yeah.
It dropped from 2.34 all the way down to just 0.50.
Okay, that's the real alarm bell, 0.50. That signals much less immediate maneuverability, and presumably that's driven by the massive drain on their cash reserves.
Exactly. Cash and cash equivalents fell by over 160 million lira in just 9 months. They settled at 96.5 million lira, down from 257.1 million at the start of the year.
So a huge chunk of their previous war chest has effectively been liquidated. Before we talk about where all that money went, how is their working capital management holding up under this pressure? What about things like inventory?
All right, let's look at stocks or inventories. They actually decreased quite significantly, from 452.8 million lira down to 311.7 million. That's a 140 million lira decrease. Now, this could be a strategic choice. Maybe they're efficiently selling off existing inventory to generate cash needed for the capex, or perhaps it's a deliberate slowdown in renewing inventory to avoid those high inflationary restocking costs.
Right.
Either way, that inventory reduction contributed cash into their operations during the period, temporarily helping to mitigate some of that liquidity pressure from the falling cash balance.
Okay, that makes sense. And what about collecting money from customers?
Receivables.
Trade receivables actually increased slightly from 137.0 million lira up to 162.0 million. But crucially, their average collection period, how long it takes them to get paid, remains stable at around 90 days. So while they are extending a bit more credit in absolute lira terms, the actual efficiency of getting that cash in the door hasn't deteriorated. Okay. But the most definitive strategic move we're seeing on the balance sheet, surely, is this dramatic change in their debt structure. They seem to have gone from being heavily cash positive to actually holding significant debt now.
The balance sheet confirms this aggressive shift, absolutely. Short-term liabilities nearly doubled, reading 192.7 million lira from 109.8 million. But more significantly, total financial debt, that's loans and borrowings, soared. It went from a negligible 1.67 million lira at the end of 2024 to 140.7 million lira by September 2025.
Wow, from under 2 million to over 140 million in debt. That proves the company has actively gone out and secured substantial new financing, presumably to fund those big investments.
Without a doubt.
So how is this new debt structured? Are they just taking on high-interest local currency debt, which would be expensive right now, or have they been a bit more savvy in how they've financed this?
They appear to have been very strategic, actually, which, interestingly, introduces a whole new layer of risk for investors to consider. The vast majority of their new long-term debt, about 77.9 million lira worth, is denominated in Swiss francs, CHF, and it carries an exceptionally low interest rate, just 1%.
1% interest. In this environment, that sounds like a gift. It must provide a huge advantage in terms of financing costs compared to borrowing in lira. But borrowing in a hard, typically appreciating foreign currency like the Swiss francs, that immediately exposes them to massive currency risk, doesn't it? Especially if the CHF strengthens significantly against the lira, it feels like they're trading off low interest costs for potentially high exchange rate volatility risk.
That is precisely the trade-off they've made. Yes, they're minimizing their interest expense burden, which is obviously critical when your operational margins are already under pressure, but they are explicitly accepting substantial currency risk exposure by doing so. And this strategic shift towards debt, particularly this CHF debt, is the primary reason for the most dramatic balance sheet transformation we've seen. The company moved from having a 333.5 million lira net cash position back in September 2024
Right, tons of cash.
to having a 63.2 million lira net debt position by September 2025.
That is just a staggering reversal, a swing of nearly 400 million lira in their net financial positioning in just 12 months. I mean, is management being perhaps too aggressive with this rapid shift, especially given that flat top-line revenue we saw earlier? They're burning through cash and leveraging up the balance sheet before this huge new capacity has even proven its revenue-generating capability.
It is undeniably aggressive, no question. But it clearly reflects management's, let's say, unshakable conviction in the future utilization and profitability of that new facility they're building. They seem to be treating this investment phase almost as an existential necessity for future growth. And they're willing to accept this significant short-term liquidity stress and balance sheet shift to secure that long-term capacity. The positive news, from a solvency perspective, is that even with all this new borrowing, their overall debt-to-equity ratio remains extremely low. It's only 4%. So theoretically, they still have significant balance sheet capacity left if further borrowing were ever needed down the road.
Okay, that's a good point on the low leverage overall. What about their equity base itself? Given that huge 294 million lira net loss we discussed earlier, how did that impact the shareholders' equity?
Well, due directly to that reported net loss under TMS 29, the Erzkanakler, or equity line item on the balance sheet, declined. It went from 1.946 billion lira down to 1.678 billion lira over the 9 months.
So it took a hit,
Yes, this just demonstrates the direct accounting impact. That large inflation-driven monetary loss, combined with the creep in operational expenses that reduce the EFK, directly erodes the reported equity base, even if the underlying business structure and assets remain physically robust.
Right. Okay, let's pivot now to what all this debt and cash burning was actually for. Let's talk about the investments themselves, the R&D strategy that underpins it, and the resulting pretty complex cash flow picture. This really feels like the core story of ATBYO's future.
Yes, this is where we really grasp the sheer scale of management's ambition. The company is clearly in a phase of hyper-intense capital expenditure. Cash outflows specifically for acquiring fixed assets, both tangible things like machinery and buildings, and intangible things like software, capitalized R&D, remained consistently high. They spent 194.0 million lira on this during the first 9 months of 2025. And that follows 235.0 million lira spent on similar items in the same period of 2024. So sustained, heavy investment.
When we see that kind of sustained high capex figure, the question always is, what exactly are they building with all that money?
They are literally building their future. The report states that the total investment commitment for their new administrative building, a new production facility, a new R&D center, plus all the associated high-tech machinery and IT infrastructure that goes into them, that total commitment has now reached a staggering 1.362 billion Turkish lira.
1.36 billion lira. Okay, just to put that figure into perspective for you listening, the company's entire annual inflation-adjusted revenue right now is only around 500 million lira. They are betting more than 2.5 years' worth of their current total revenue on this single massive capacity jump. I mean, how much faith does that require from management and investors? And what are the operational dangers if the utilization rate of this huge new facility falls short of expectations once it's up and running?
It requires immense faith, you're right. This level of commitment fundamentally redefines the company. They aren't just expanding slightly, they are actively attempting to vault themselves into a completely different league of manufacturing scale and R&D capability. The danger, of course, is that once that facility becomes operational, very high depreciation expenses are going to start hitting the profit and loss statement every quarter.
Right.
And if sales volumes don't increase exponentially, to actually utilize that new capacity and, crucially, cover those substantial new fixed costs, then the resulting financial pressure on the bottom line will be severe. The clear strategy here is prioritize building capacity now, even at the cost of short-term cash preservation and profitability.
Did they manage to soften the blow slightly? Did they get any government support to help mitigate some of this massive cost?
Yes, they were strategic in leveraging available government programs. They hold something called an Investment Incentive Certificate, or YTB. The value of this certificate was increased to cover up to 198.7 million lira of the eligible project costs. And the report shows they successfully utilized 142.2 million lira of this incentive during this 9-month period. So that definitely helps offset some of the direct cash burden of the investment.
Okay, good. Now let's connect that enormous capital commitment back to the intellectual core of the company, the R&D center itself. Are these huge investments actually yielding immediate, tangible commercial results? Are new products coming out?
The output rate is actually astonishingly high. The report states the group is simultaneously executing 21 distinct R&D projects right now. And critically, during this 9-month period alone, they completed the development and launched the commercialization of 69 entirely new products.
69 new commercialized products in just 9 months. That sounds like a relentless pace. That's almost 2 new products hitting the market every single week. What kind of products make up that stream?
Yeah, the portfolio is highly diverse, and it reflects their core expertise. It breaks down roughly like this. 35 new real-time PCR kits targeting various viruses and bacteria. 4 new kits specifically for human genetic mutation analysis. 19 new kits aimed at the food analysis and quality control market. 6 new rapid cassette tests, those simpler, faster tests. And then various supporting isolation systems and software updates as well.
Wow.
So this high output rate, it really does validate the quality and effectiveness of their R&D spending. It confirms they're actively generating the kind of proprietary high-margin products that will be necessary to actually fill all that new 1.3 billion lira capacity once it comes online down the road.
Okay, so the picture is high gross margins, still a tiny positive operational profit before R&D capitalization effect, and this massive investment pipeline churning out new products. But they flipped into negative territory on a really crucial metric. Operating cash flow. What does the Nikita Kush Tablosu, the cash flow statement, reveal about the actual cash generated from day-to-day operations?
Yes, this is probably the single most concerning data point for the company's current operational health. The net cash flow from operating activities, the IF&A line, it saw a catastrophic reversal. It flipped from generating a strong positive inflow of 176.6 million lira in the first 9 months of 2024, down to generating a negative 4.6 million lira outflow in the same period of 2025.
Negative operating cash flow. That's always a flashing red light for any business, isn't it? It basically means the core function of the business, selling products, collecting the cash, paying suppliers and employees, that whole cycle did not generate enough cash to cover its own basic working capital needs during this period. Why the sudden collapse? From positive 136 million all the way down to negative.
Yeah, we have to look closely at the changes in working capital components on the cash flow statement. Even though the operational profit, the EFK, was still slightly positive at 8.57 TL, the changes in things like inventory, receivables, and payables actually absorbed cash overall. Specifically, even though inventory decreased, which usually generates cash.
Right.
The increase we saw in trade receivables, meaning more money, was tied up with customers waiting to be paid, combined with other shifts in working capital accounts. And crucially, the need to service those rapidly rising operating expenses we discussed earlier, like marketing. All that caused a net drain. Simply put, the cash actually generated by sales, after accounting for who they paid and what raw materials they bought, just wasn't enough to sustain the operation's cash needs during those 9 months.
Okay, so that confirms that the operational efficiency weakness we identified back on the P&L, those rising marketing costs, the collapse in other income, it's not just some abstract accounting issue. It manifested as a critical cash flow problem right now.
Absolutely. It's hitting the bank account.
Yeah.
And this strain, this negative operating cash flow, it perfectly explains why those financing activities became so vital during the period. Cash flow from financing activities provided a net positive inflow of 60.5 million lira, thanks entirely to that new borrowing we talked about.
Oh.
So that debt was necessary not just for the massive capex investment, but also, critically, to plug the temporary but significant hole created by the failure of the core operating activities to generate sufficient cash on their own.
Okay. Finally, let's address management's own view on solvency and also dig into the financial risks tied to this aggressive strategy, particularly that Swiss franc debt. What are they saying officially?
Right. Management's official statement, which is contained in the report, provides assurance on the solvency question. They explicitly affirm that despite that substantial reported net loss, which again is driven mainly by inflation accounting, the company is not in a position that triggers the concerning Article 376 of the Turkish Commercial Code, the one dealing with capital impairment or potential insolvency.
Okay.
They state clearly that the group is fully capable of meeting all its short-term obligations. And that claim seems largely supported by that still quite high current ratio of 3.71 we discussed earlier.
Okay, solvency seems okay for now. Let's focus specifically on that currency exposure, though, which is definitely heightened by taking out that low-interest Swiss franc loan. What's their overall net position regarding foreign currencies?
Well, interestingly, the group as a whole actually maintains a net foreign currency asset position. As of September 30th, 2025, this net asset position stood at 124.8 million lira. This buffer, which is primarily composed of US dollar and euro receivables generated from their extensive exports, it actually provides a kind of natural hedge against the depreciation of the Turkish lira. If the lira weakens, the lira value of those foreign currency assets increases.
Okay, so they have some protection from a weaker lira overall. What are the specific risk sensitivities mentioned in the footnotes regarding currency movements?
The sensitivity analysis included in the report shows that if the euro and the US dollar were both to appreciate by 10% against the lira, the company would actually see a net profit increase of about 20.2 million lira, precisely because of that net asset position. So, continued lira weakness, broadly speaking, benefits their bottom line.
Okay, but the Swiss franc debt is a specific liability risk separate from that net asset position, right?
Exactly, that's the specific counter risk. The report explicitly notes that a 10% appreciation of the Swiss franc, which, as we know, is a very stable and often appreciating currency globally, would result in a net loss for the company of about 7.8 million lira. So, while their overall net asset position in dollars and euros provides broad protection against lira weakness, any significant strengthening of the CHF specifically could substantially increase their cost of servicing and eventually repaying that CHF debt in lira terms. That's the specific currency risk they accepted in exchange for getting that very attractive 1% interest rate.
Right, a calculated gamble. And lastly on risks, what about guarantees? Collateral placed on company assets. Did all this new borrowing increase the level of encumbrance on their assets?
Oh, it did, dramatically. The total amount of collateral, pledges, and mortgages, the TRK line item provided by the company against its own assets, rose very sharply. It went from just 20.5 million lira at the end of 2024 up to 117.4 million lira by September 2025.
Wow, that's more than a five-fold increase.
Yes. And that directly correlates with the assets they've had to leverage to secure all that new financial debt. The debt that's primarily funding that massive 1.362 billion lira strategic investment push.
Okay. This really detailed analysis paints a picture of a company at a fundamental crossroads, doesn't it? Anatolia seems to be a validated technology leader. I mean, confirmed by the WHO, no less, but one that is intentionally, strategically inducing significant short-term financial stress, specifically to fund a massive jump in future capacity. Now, for you, the individual investor listening, trying to make sense of this, what are the, say, 5 essential conclusions we can distill from all this complex data?
Yes, we've spent this whole deep dive connecting those dots. So here's the Investor's Digest, the key takeaways.
Okay, let's start with the operational core, the good part.
First, the unshakable strength of the margins. That 65% plus gross profit margin is incredibly robust, and it's stable. This is the absolute bedrock of the entire business. It confirms the proprietary value and the pricing power of their molecular diagnostics technology. It proves the basic value proposition is fundamentally sound.
Okay, number 1, strong margins. Second, addressing the operational weakness we found.
Second, severe operational pressure and efficiency loss. The operating profit, EFK, and that underlying EBITDA margin have, frankly, collapsed. This is due to those skyrocketing marketing expenses and the doubling of miscellaneous operating costs, compounded by the disappearance of that non-recurring operational income from last year. Management absolutely must regain control over these costs to stabilize the core operational profitability before that huge new facility comes online and adds more fixed costs.
Right, cost control is key. Third, the balance sheet stress and the shift in funding.
Third, the cost of ambition and the shift to net debt. The company made a clear, strategic, and very aggressive move to finance its massive 1.362 billion lira expansion plan primarily through debt. This choice directly depleted their substantial cash reserves and leveraged up the balance sheet, resulting in that huge 400 million lira swing from a net cash position to a net debt position in just 1 year. This short-term liquidity contraction is simply the necessary price they're paying for their long-term capacity-building ambitions.
Okay, ambition costs money. Fourth, that headline number distortion we kept coming back to.
Fourth, the pervasive distorting effect of inflation accounting. That reported net loss of nearly 300 million lira, 294.6 MPL, fundamentally misrepresents the company's underlying performance. It is primarily a paper loss, driven by that massive 265.8 million lira net monetary position loss, which is mandated by the TMS 29 accounting standard in high inflation environments. The underlying business, although definitely under pressure operationally, remains marginally operational profit positive before R&D capitalization.
Got it. The accounting masks the reality. And finally, number 5, the critical issue of actual cash flow from operations.
Fifth, the negative operational cash flow warning sign. That flip from generating strong positive operating cash flow in 2024 to burning cash from operations at a negative 4.6 million TL in 2025 is arguably the most concerning short-term operational metric right now. It indicates a temporary but significant breakdown in working capital management efficiency that actually had to be covered by taking on that new debt. This negative trend absolutely must be reversed quickly to reduce their reliance on external financing just for day-to-day operations.
Okay, this analysis really provides the full strategic context, doesn't it? ATBYO is making an enormous calculated bet on its ability to scale up globally, backed by those strong margins and seemingly world-class R&D.
It really is a classic high-stakes growth strategy. You see it sometimes. They are quite literally trading today's financial stability and reported profitability for what they hope will be tomorrow's significantly larger market share and dominance.
So what does this all mean for you, the individual investor, maybe watching the stock price fluctuate, looking at those confusing reports?
Well, the key question for valuation, for deciding if this is a good investment for you, it really boils down to a risk-reward calculation and, critically, timing. The company has secured relatively low-cost financing for a truly massive, potentially transformative capacity expansion, and it's backed by proven high-margin products. The fundamental question you have to ask yourself is this. Will these incredibly substantial investments translate into a sufficient, sustained, and importantly, immediate enough revenue boost? a boost that not only restores the currently declining operational profitability we've seen, but also creates enough sheer scale and cash generation to finally overcome that persistent systemic financial drag imposed by these perpetual inflation accounting losses, thereby securing a sustainably profitable net bottom line.
It really is the ultimate test of management's foresight, isn't it? And their execution efficiency going forward. Will the ramp up in sales of those 69 new products they just launched happen fast enough and at high enough volume to actually justify leveraging more than 2 years of current revenue into building a single new facility? That's the core strategic decision investors really have to weigh up.
Absolutely. Analyzing financial reports isn't just about reading the numbers that are already there. It's about trying to predict the likely outcome of these kinds of strategic gambles that companies make. Hopefully, this deep dive has given you the necessary tools, the context, and the critical questions to ask so you can make that prediction for yourself.
Thank you for joining us for this incredibly detailed analysis of Anatolia Taneve biotechnology. If you found this deep dive useful, please do hit that like button, subscribe to the channel, and maybe share this with others who you think need that shortcut to being comprehensively well-informed on companies like this.
Yes. And until next time, stay critical, always try to focus on the underlying operational narrative, and keep questioning those headline numbers, especially in high inflation environments.